How's it going, everybody? We're going to be chatting about some ETFs in this video. This is kind of like an extension to the previous video that I made, where I kind of went over my passive income investing portfolio strategy. I wanted to talk more specifically about some of the ETFs that are going to be adding to that portfolio. I guess that are already in the portfolio, should be pretty transparent, but they're a pretty small percentage, so when opportunities do come up, I do want to pick these up. I also want to kind of go over some comparisons and some other companies that, some more ETFs that I guess should be compared to, because like, why'd I pick these over the other ones? But we'll get into that in a little bit. Right now, the two ETFs in my portfolio are SCHD and VYM Vanguard High Dividend Index Fund ETF shares, and the Schwab US Dividend ETF. I think most people have already heard of these. They're pretty common, to be honest. They're pretty well traded and known, and a lot of people have them in their portfolio. I guess it's kind of one of the main reasons that first struck my interest. But right now these, for the most part, in my opinion, a lot of these higher dividend yielding ETFs, i.e. ones or ETFs that are yielding about 3% or above, maybe 3 to 4%. I haven't really seen them 4%, but 3 to 4%, they all have roughly the same amount of, or the same stocks in them in the percentages, but sometimes some of them are a little bit better managed in a sense. That reminds me also, I wanted to pull this up. We're gonna get into this in a little bit. Let's just go down here. Cool. Okay, because that's the prospectus for SCHD. Let's first go over SCHD. This one I like right now. I mean, I don't love it, but it's yielding about 3.44%. Now, this took me a while to understand. It kind of makes sense though, but how these dividends actually work is obviously they fluctuate quarter to quarter because of the company, the ETF, whoever's managing it. They have rules that they have to, kind of follow. I guess actually this brings up a good point. We'll go to here really quick. Like some of their rules are the Schwab one, like they can only have no single stock can be 25% or more, and no single stock can be 4% or more. So if stocks do increase a lot, they do have to sell. Another thing too is the turnover rate. I want to mention the most recent fiscal year, the fund's portfolio turnover rate was 14% of the average value of its portfolio. So that kind of means that over the last year, 14% of the stocks kind of were traded not traded in some way, I should say, but actually now that I'm thinking about it, what is the actual definition of that? Asset turnover. The fund-based transactional costs such commissions when it buys and sells securities or turns over its portfolio. A higher portfolio turnover may indicate higher transaction costs than mere sold, and higher taxes when fund shares are held in a taxable account. These costs, which are not reflected in the annual fund operating expense, are an example of fund that performs during the most recent fiscal year. Okay. So, the fund-based transactional costs, such as commissions when it buys a turnover portfolio. Okay. So, I mean, the higher the portfolio turnover rate, the more that the fund is going to pay in, obviously, transactional costs. But that also kind of means that, in a sense, in my opinion, or my head, maybe not opinion, but the fund is a little bit more actively managed. If we were to go to Vanguard's one, I don't remember where it is. Actually, I don't think it's on here, but theirs was like 8% turnover rate. Let's see if it actually has it here somewhere. But 8% means that there's less transactional costs in a sense, but they're also paying a lot less in commissions and fees. So it depends how you look at it. Well, we can actually do some comparisons too. How did I do this last time? I just want to do, there's obviously some other ones we can do, but right now I'm just doing these two. I don't think this is the best way to illustrate something, but if you look over the last 5 years, the Schwab dividend returned about 47% while VYM only did about 28, not including dividends. Now, key thing is the same expense ratio, which is nice. They have roughly the same, market cap, I guess, of the fund or the stocks in it. And where else does it go with this? Yeah, they have roughly the same stocks in it. Right now, VYM is yielding, I think it was like 3%, and Schwab was yielding, or SCHD was yielding about 3.4. And over the last 5 years, they returned, what is this, like 20% more in appreciation. Now, obviously, just because a stock ETF performed better over a 5-year period doesn't mean it will also perform more in the next 5 years compared to another asset, but it is something just to take into consideration. But I guess from my opinion right now, if I had to choose between SCHD and VYM, I would obviously pick SCHD because not only is their dividend yield higher, again, they have the same expense ratio, they hold roughly the same amount, the same stocks, it's just yielding higher, and there's, I guess, more actively managed in a sense because that asset turnover rate. Obviously, I could be a little bit wrong in this, and just to show you the holdings, holdings, got Broadcom, Appy, Home Depot, USPS, Pepsi, Coke, stuff like that. Here we have Exxon, J&J, Procter, Broadcom, Home Depot, Chevron, Pepsi, Appy, so I mean it's roughly just the same good stocks. The top 10 holdings, interesting, actually, the top 10 holdings of Schwab ETF is 40% of all the holdings in the company. Which this is interesting too, because there's 4 stocks right now, almost 5 if Pepsi keeps going up, or they will have to sell partial or some other shares before the quarter ends. Or is it quarter, year? What did they say here? Jones over here. 4% of single rebound annual index is reviewed annually and rebalanced quarterly. So yeah, every quarter they're gonna have to sell some Appy and Home Depot and stuff. Go over to Vanguard's one. Their top 10 holdings are only 25% of the total amount. Sorry, their top 10 holdings represent 25% of the total portfolio. So the Schwab ETF has a lot more, I guess a lot less, I should say, diversity in the companies, which, is that a good or bad thing? I don't think it's necessarily good or bad thing. Again, it comes down to personal preference and why you want to invest. If you want to invest in something a lot more broad, or many more companies, maybe VYM is for you. I guess now that I think about it, I could just do this and it'd be a lot easier to compare. I kind of want to see this. So financial, so VYM leans a little bit more towards financials at almost 20%. 20%. As Schwab is about 15%. More in the industrials for Schwab. Almost no real estate in VYM, and actually they don't even have real estate in here. Interesting. So financials, consumer, defensive, healthcare, industrials, financials, healthcare, consumer defense, technology. That seems a little high. So okay, this is one thing too. The Schwab ETF. Again, I don't know if this was. I don't know every year how much more or how this percentages fluctuate, but tech is about 3% less over here. I mean, like, again, tech, the dividends are a little less, but the appreciation has been a lot greater the last, couple of years, so that could have been attributed to that higher increase in appreciation, so just something to take in mind. I'm going to quickly go over to this. This is Schwab's ETF. Almost all the companies. This is the top 40. Sorry, this doesn't have dark mode on it. This is as of July 19th. That must have been when the quarter ended. But we got Broadcom, UPS, Texas Instruments, Cisco, Home Depot, Pepsi, Coke, Amgen, Appy, Verizon, America, U.S., Chevron, Pfizer, BlackRock, Lockheed, Automatic Data Processing. What actually is that? ADP, I'm kind of curious. Ford, they got a lot of stuff, but it's a lot of like kind of well-known names too. But yeah, you're getting a good basket of a lot of stuff. But I guess I should still probably go back to how do we want to do this? So my thing is, roughly, in my opinion, these are almost the same ETFs. Like, I guess from a strategy point of view and what they accomplish in a portfolio, you're getting a wide range of basket of goods. Expense ratio is the same. Yeah, so it's like if one is yielding higher, I'm probably gonna go with that. So the one reason why I'm picking two is because I want, like, what if something happens to Schwab or something happens to Vanguard? Something probably won't, but I don't like the idea of putting a lot of money into just one other company, if that makes sense. So I would rather, if they both do the same thing, I'm gonna obviously gonna want to lean more heavily towards the one asset that seems like a better value. But I don't mind splitting it a little bit to cover the risk of, let's say, one company completely. I don't know. I just. Maybe that's a dumb that I'm saying it out loud, but I don't know if that makes sense to other people. If I'm just being paranoid. Maybe I'm just being paranoid. Anyway, that's kind of my initial thought on that. We can do is, let's go compare. So Seeking Alpha's got some pretty good thing over here too to compare some stuff. I mainly want to focus on dividends. How do we do this? The performance. This is for the cash flow, or VOOV is another one I think people like. Sorry, I'm getting really sidetracked, but VOOV, the yield is 1.87. Like, I don't care. I immediately don't care. And I get, but the appreciation's better, and I get that. I completely understand. But for my portfolio is a very risk-adverse, cash flow-based focused portfolio. So I don't want that when I know I can go get 3.5% or like even 3% elsewhere. So let's actually do some pretty different filters. Let's go to dividends. Dividend growth, dividend trailing 12 months. Let's take out that. Holdings, turnover, performance. Let's actually do a 5-year performance ratings. Dividends, risk. Okay, let's try it. Let's see what comes up. Maybe I should put the ratings on 71 or so. I guess we'll just do the quant rating. It's not perfect, but sure. Let's see what the quants. This is not popping up, but I thought it would. Hold on. Strong sell to strong buy. No, I want a strong buy. Where do we go? Why is this different than what I remembered? Okay, let's actually start all over. No, I don't want to export it. Let's start over. Alright, add filters. We want to go to dividends. We want to go to trailing 12-month dividend yield. Sure. Let's add the quant rating. Actually, I may have to reset this. I think I messed up too hard. Yeah, let me do this. Let's run it back. See how they're giving like nice scores. I need to have. Yeah, let's make it simpler. Let's just put the dividend on and call it a day. So this is saying, see, this is D dividend, but it's the highest rating. Let's actually see what is this. Again, I don't think this is like the best way of like finding a dividend, ETF, but it's kind of nice to look at all of stuff. But this is yielding like 1.6%. Yeah, no thanks. Here's the S&P. Let's sort it by dividend rating. Let's see, D. Okay. Sorting it by dividend, and the A+ plus category. We got 8 options. We got VYM is one of the nice. CHD, same thing. Nice dividends. Let's see. Fidelity's New Millennium ETF sounds promising. Yielding 1.17C again. Like, yeah, I get the appreciation, but again, it's not part of the goal. Let's see. Fidelity Blue Chip Value ETF. Let's see what that is. Yielding 2%. One thing too with these ETFs, and just kind of saying in general, is I still think the market's a little expensive, and because of that, I think these ETFs will go down a little bit in value as the market does as well. So that's kind of one reason why I'm not really picking up a lot of stuff either. iShares Core Dividend and Growth ETF. And this is got some decent ratings. Let's see, 2.3%. Obviously, there's other factors taken into consideration too, like how much is the dividend growing, and I mean, I guess this started from, let's say, 60. Yeah, it's not like, depends on the and average annual payout growth about 8%. 1, 7, 14, 10, 8. Okay, kind of a new ETF too. Like, just because again a dividend growth ETF grows 8% a year, let's say, it doesn't mean next year it's also going to grow 8%. It's just something to keep in mind. That CH, sure. I have to think of like an acronym to pronounce this, but if we go to here, dividend history, I want to show you the last 10 years. They're paying like 25 cents, then they went to like roughly 50. Now we're kind of squeaking up to the 75 zone. So if I buy this if I buy this ETF, I'm expecting at least 50 cents a quarter in dividends. I mean, maybe a little more, like 60 cents, but just being a little bit more like cautious in a sense. Not cautious, but conservative. So about 50 cents I should be earning per quarter on that money. What's this growth looking like? So even though this isn't considered a quote dividend growth ETF, here we get the dividend growing 11%, 15, 9, 9, 9, 6, 19, 17, 10, 13. Interesting. That seems like a lot. Annual payout growth. This seems. Hold on a minute. How can the dividend be growing? Sorry, it's not my mouth. I guess that's a year-to-year basis, right? Let me see. Yeah, year on year. Sorry. Actually, yeah, but I'm so confused. Oh, okay. There's the quarters too. Can I? I want to see it. I'd rather see it by year, not by quarter. What if there's a way? There probably is, but anyway. So, one thing interesting too is over the last 10 years with this ETF, we can see that roughly 3%, it has not gone like above 3% yield, like really ever. During COVID, it went to like 4.25. Now it's like at like 3.5 in the 3.4 area. So this, from a dividend yield perspective, it's in the higher range, which I'm not gonna say it's cheap, because I don't think saying, oh, a dividend yield, it's yielding this much, that makes it cheap. What I'm saying is, relatively, the dividend is attractive at an attractive yield based on the price. Obviously, dividends can go, or if the price of the ETF does go down and the market does bad and companies are forced to not pay as many dividends, then yes, the dividend growth, I guess, or dividend itself will go down. But historically, for the most part, when you spread your risk over many companies, I think it's unlikely that a lot of them do that. Like, I mean, maybe Verizon's dividend might get cut, or 3M, but I think a lot of other companies should be okay. Again, I always like to think about the risks. I want to go VTV paying 2.43. I want to go back to VYM really quick and do the same or something similar. Look at the dividends. What's their growth looking like? 19, 321. So I mean, again, you can have periods of time where things go bad. One thing that I do like about this, the VYM, is they have went through the 2008 recession So it kind of has, I guess, more, not sticking power, I want to say, because it just means it's an older asset, but it's better data, I guess, because it's a lot more data, and you can see how an asset like this will perform in a very bad time. I mean, even during COVID, it still went up 2.25%, but this is really bad. So, dividend yield. Oh wow, during COVID, this went to like 6% yield, 5.5. But yeah, around 3% is where it like hovers, and it's pretty consistent. So like, if I were to buy this asset, I would not like if it was about 3%, I would say that's a fair value of where the asset probably should be purchased at, and that's just based on like historical facts, right? Like, I'm not expecting to buy this at like a 4 or 5% yield, but if it doesn't get there, I sort of know that it probably is attractive to buy at that specific time. Obviously, it might not be, but again, I'm just trying to not generalize, but I'm trying to find points in time where being smart by buying certain assets. Obviously, people say you can't time the market. I can look at this chart and kind of say, oh, with some certainty, if VYM all of a sudden shoots up to 40% yield and the market's falling, I can say, you know what, maybe it's not that bad of an asset because it's got that kind of sticking power, it's got the kind of risk-off point of view, and relatively, yeah, I think about a 4% yield. If it doesn't get there, it might be trading relatively cheap. But then again, I want also, again, take into consideration that the dividend yield might go down also because the stocks stop paying certain dividends. So again, there's that side of the coin or side of the sword also, but that's kind of how I'm, kind of trying to be a little smart. But again, like, if I'm looking at, I could get 3.5, 3.4 right now here with potentially higher appreciation. Why would I buy VYM? But then, yeah, obviously we got it's a big conversation. Comes down to the individual person. Real quick from, yeah, just momentum. I don't care about momentum for this portfolio. Expenses, they shouldn't have any expenses. Dividends, we want that good. Risk, I want that to be off. I want it to be A. Liquidity, I want it to be pretty liquid. So that immediately kind of, not to say removes these, but we already kind of went through those and they already showed pretty bad. It doesn't align with what I want. Schwab ETF and a VYM looking pretty nice in the categories that I want. Here we have Victory Shares, US Large Cap High Div Volatility. What the heck is that? This is yielding for 3.4%. I do like some of these articles too. Let's see what they have to say. What are they holding? It's always important to know what they're holding too. So they're a little bit heavy. They're weighted in utilities. So again, that's a little more cyclical. Utilities, financial, consumer, defensive. That's pretty heavy. Let's go to. Oh, I'm sorry. I forgot about Kimberly Clark. Let's see their dividend growth. Wow, 22%. 9, 5, 12, blah, blah. Pretty little, kind of inconsistent, their dividend yield. If this, I'm trying to think of how to word this, if this ETF, mostly high div volatility, I don't know what all that, I don't know what WTD, I'm thinking like a volatility, I wish they have to say it on here, like, I wish they put the prospectus on here. Anyway, though, yeah, I guess why wouldn't I buy this one? Oh, it's yielding 3.4%. I could just go buy CHD, yielding a tad bit more. This has a higher expense ratio, and to me, they're holding too many utilities. That's too cyclical. Utilities and even energy's a little cyclical too, but you obviously kind of want some ETF to hold energy because the yields are usually higher. So I'd say about 10% is okay. Utilities, yeah, look, CHD, no utilities. I bet you VYM also has no utilities. up 7%, I lied. But I think 25% almost is pretty high. Let's get that out. Yeah, we looked at that one. Sure. iShares Select Dividend ETF, 3.5% higher expense ratio. Okay. What are they holding? A lot of you, 27% utilities. We got Trio, Matt. Yeah, that's why their dividend's so much higher. Verizon. So one of the things too is, obviously, you kind of want, like any company could go buy all, or any ETF could go buy Altria Group right now, and the dividend's 8%. I feel like I'm not gonna say it. It's okay. Obviously, if ETFs have Altria Group, but I don't think it should be. I'm trying to think. Is it cheating? I guess is what I'm trying to say. Not cheating. I'm trying to figure out how to word this. Because think about it. If you own an ETF, and you're like, okay, I want to increase my yield, or it's like, oh, okay, Altria Group's yielding a lot, but it's kind of a little more riskier in a sense. Maybe that's my opinion, but then they just buy a whole bunch of Altria Group and it inflates the ETF. I don't know. I don't know if that makes sense. How do I word that? Anyway, I'm just gonna drop whatever I'm gonna say because it doesn't really make sense. Alright, let's look at like one more. So this is an F in expenses. What if you're an ETF? What are you spending money on? Are you options trading? Yeah, 9% yield. This has to be an options-based strategy because there's no way you're gonna get that. Simon Property, Prudential, Johnson Johnson, and you got some really high-paying dividend stocks here. But here's the thing. Let's see something real quick. Last 10 years, how does this thing do? Oh, it's only been around for just 20. Yeah, this has to be options-based because it's a 1% expense ratio. What the heck is this? Let's go to Yahoo Finance, I think. I'm just gonna go to Yahoo Finance really quick and see what this is. What am I looking at? The fund under most certain conditions will invest at least 80% of his net assets. I'm so confused. Regardless, I don't trust something with 9% because it just makes no sense. Yeah, expensive dividends are great, nice, but the risk is incredibly risky. Yeah, I don't trust that dividend at all. I'm gonna just to see for fun, dividend growth. I've only had 1 year, so. Yeah. Let's just get out of there. If a dividend has expenses, if the dividend has a lot of expenses, probably not good, just saying. Expenses should be in the A+ category. Let's see what else, anything popping out. Maybe Mega Cap, Value Index Fund, ETFs, Vanguard, two almost and a quarter. Not terrible. Dividends. Dividend growth. I mean, honestly, like an 8% dividend growth is still pretty insane. Like, actually, what's that math? Let's do that really quick. Hold on one. Okay, I want to do that. I want to do some quick math. Let's say you got $100,000, right? And you're yielding 3 point. Let's just say 5%. Why not? That's not gonna work. 0.35%. And let's say it's growing 7% a year. Let's be pretty optimistic here. 7% a year. So let's do like year 1, 2, 3. Let's just stretch it out to like a couple years. I don't know. Let's do like 10 years, sure. Now, year 1, you're gonna have that times that rate. Sure. Yeah, then we're gonna add that. So let me just make sure. Okay, so that is your end of the year, year 1. Cool. Actually, I probably should have 2 columns. So this is your year 1. The next column, you're gonna have that times that plus your initial yield, that seems better. Let's make sure this works. Yes. Am I dumb? Why'd I put it up there? 3%. This one we're gonna want to add there. Actually, am I dumb? Okay, let's lock that cell. Sure. That seems way too high. Let's assume 7. Assume 6%. That just seems way too high. So now we're getting the cell above times that plus the cell above. Actually, what am I doing right now? In my mind, this made sense, but now I'm thinking about it. Hold on. Let me just keep going, then I'll see. We don't need these decimals. Just who cares? Okay. Let's stretch that down. Did something wrong. That. Okay. This we want to go there. There. This one we want to go. Yeah, we let that go there. There. Yeah, why'd that do that? I'm so confused. Am I dumb? This cell above. Okay, duh. Okay, I don't think this matters up here. I just wanted to see that, let's say, on a $10,000 investment, let's say you bought at 3.5% yield, and you were anticipating a 6% dividend growth. In 10 years, you can expect about a 5.9% yield on the initial $10,000. So you'd be making about $590 from that every year, not including taxes. And I don't know if that includes the expenses. Sorry if you hear my cat munching away back there. But yeah, just wanted to do some quick math just to... hopefully that math is obviously right, I'm pretty sure it is, but... That's... but I don't like putting numbers in Excel and being like, I'm Excel rich. I don't like that because it's, in 10 years I'm gonna get a 5.5% yield on my money. It's like, bro, again, there's so many better things to do in the world to make money than to just buy stocks or invest in ETFs or even like bonds or anything. You know what I'm saying? Like, there are more productive ways of making money. But I also want to just mention that obviously, like, this is pretty passive and you kind of need it, but yeah, that's just my kind of 2 cents on that. This can't be the only goal in life, is to somehow make or put like $1 million. Like, yeah, it's a quick side tangent for the people still listening. I think for like years I was like, all I gotta do is get like $1 million, and then I gotta invest it at 4%, and I'll be making 40 grand a year, and I'll like never have to work. And it's like, bro, once I started working and saving money, I was like, wow, I am never getting to this goal of like $1 million in like stocks or bonds. It's like, it's hard. You have to do something in the meantime, and you can't. Okay, it's gonna depend on you as an investor, and kind of what you want out of investing in life. But I don't want to save 20 to 25%. Even actually, I guess I'm saving more. I don't want to invest, let's say, 25% of the money I make into the stock market or like bonds, because like it'll take me like 80 years to be a millionaire. But you have to recognize you still have to do that because it makes sense. But also, if you're young, that's the time to take risks. And I'm not saying necessarily risks in stocks. Like, I'm saying business risks. I'm saying try different ways of, there are other risks to take financially besides just trying to be good in the stock market or pick selective stocks. But the money that I invest like this, I want this to be very secure and safe, but also have some reliability to it. The other stuff I'm doing outside of work, out of stocks and investing in bonds and ETFs, that to me is a little bit more risky in a sense where like I will put more money into that in hopes that I guess I generate some additional money, but anything that goes into this, I want it to be less risky, if that makes sense. And that has been my investing kind of switch. But yeah, I think that was kind of all we needed to chat about. Yeah, until next time, stay tuned for some more videos. Definitely let me know down below some of your favorite ETF stocks. Sorry, I keep saying stocks because it's like all I know. Not all I know, but you know, I made not thousands, like hundreds of videos, and they're all about stocks. Let me know some good ETFs down below. If anybody knows of a good ETF that fits my dividend kind of criteria, also being less risky, but it's gotta be yielding above 3%. Because if it's not, I'm gonna buy something else. Like I'm gonna buy this. I'm gonna buy a bond. You know, and there's better stuff out there to buy. But again, let me know down below. Always appreciate the knowledge sharing. Take care, everybody. I'll see you next week.